Hello students, welcome to Aksharaha, an initiative by Anveshan Educational Trust. In today's learning process, we begin with a basic understanding of auditing. We will first discuss the meaning, definition, nature, scope, and finally conclude the session by answering a couple of questions. So, what does auditing mean? Auditing, in traditional terms, originated as the process of verifying financial accounts. Easy, right? Simple. Although interesting fact, auditing was practiced in various ancient societies, including India. In fact, Kautilya's Arthashastra, which dates back to the 4th century BC, mentions the concept of auditing. It discusses fixed accounting years, the process for closing accounts, and the auditing of those accounts. There are references in his monumental work to misstatements in financial statement due to abuse of power. Wow, wasn't he far ahead of his time? Now, to understand the meaning of it, audit means the systematic examination of books to verify the authenticity and accuracy of recorded transactions. It is to verify whether the submitted financial records are true and in compliance with prescribed accounting standards. That involves scrutiny of vouchers, invoices, documents, bills, and cash memos. Now, let us further understand this with the definition. The Institute of Chartered Accountants of India has defined auditing as an audit is an independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form. When such an examination is conducted with a view to expressing an opinion thereon. So, the auditor reviews and understands the financial information presented for examination. He gathers all of this evidence, assesses it with an unbiased, free of any sort of influence, and based on all of this information, he formulates his judgments, which are conveyed through the audit report. His opinion is expressed via an audit report. Its nature encompasses several key characteristics: systematic process, independence, interdisciplinary approach, professional execution, specific purpose, and provision of assurance. Systematic auditing follows a structured, methodical approach with predefined steps like planning, evidence gathering, and reporting. This ensures comprehensive coverage and logical progression, reducing errors and enhancing reliability. Independent. As already mentioned in the definition, audit is an independent examination of financial information. Here, independent implies that the auditor is not the subordinate of the person who hired him, nor is he tied with the entity in any way. He is independent from the entity whose financial statements is being audited so that he can conduct a fair, unbiased audit. Independence increases the auditor's ability to provide an objective opinion free from any bias. Interdisciplinary. Auditing draws from accountancy, law, statistics, economics, behavioral science, and financial management to evaluate systems, controls, and evidence effectively. This broad knowledge base enables auditor to address complex issues holistically. The next being conducted by professionals. Only qualified professionals such as chartered accountants perform audits, adhering to ethical codes like integrity, objectivity, and competence. They apply standards on auditing essays for consistent quality. The next being specific purpose. The primary aim is to form an opinion on financial statements' fairness per the applicable framework, as in whether it is following the applicable framework or not. Not to verify every transaction or guarantee absolute accuracy. Scope excludes management's responsibility like recording preparation. It is only to form an opinion, only to go through all these statements and prepare an opinion or prepare a report as to what findings they have come up with. Provides assurance. Auditing's basic nature lies in providing assurance to the users, providing confidence that financial statements are free from material misstatements which are formed due to fraud or error, boosting user confidence through the auditor's opinion. Now, let us move on to the scope of auditing. Scope refers to the range of something. The purpose of an audit is to enhance the degree of confidence of intended users in financial statements. Users of such statements are its stakeholders. both internal and external. Enhancing confidence involves the auditor expressing an opinion on whether the financial statements are prepared in accordance with the applicable financial reporting framework or not. The first scope being all aspects of finance and accounting relevant to an entity should be addressed. So you just cannot bring a list of people whom you have hired or whom you have fired. That is not relevant. Bringing such information is of no use. Only bringing finance and accounting relevant information. Financial statement audits should be thoroughly organized to address all relevant aspects of the entity. The second scope being the auditor should be satisfied that the information contained in the underlying records, like bills, vouchers, documents, etc., is reliable and sufficient basis for preparation of financial statements. The auditor can only arrive at such conclusion after careful examination, appropriate tests, inquiries, and assessment of the accounting system, financial data, records, and internal controls of the entity. Third point, the auditor should also decide whether relevant information is properly disclosed in financial statements. He should also keep in mind applicable statutory requirements in this regard, as in what is required legally and what the ICAI prescribes, what the current standards prescribe, whether he should keep in mind whether such things are being complied, whether such factors are being regarded. It is done by ensuring that financial statements properly summarize transactions and events recorded therein and by considering the judgments made by management in preparation of financial statements. The next point, the auditor is not expected to perform duties which fall out of his domain. As in, he is not supposed to prepare the financial statements, he is not supposed to submit them, he is not supposed to keep them in an organized manner. That is the management's duty, that is the entity's duty. It is not his domain. He is not responsible for proper preparation and presentation of financial statements, nor does he hold any expertise on authentication of these documents. The last point being, an audit is not an official investigation but rather an expression of an opinion of financial statements. It is conducted to provide reasonable assurance of whether the financial statements is true to its contents and is compliant. Now that concludes till the scope. Further on, now let us discuss a couple of general questions regarding auditing. So auditing, is it mandatory or voluntary? Audits aren't always legally mandatory. There are entities like companies that are compulsorily required to get their accounts audited under the law. Even certain non corporate entities might have to conduct such mandatory audits of their accounts under the law. There are certain legal requirements, there are certain legal thresholds that states that such entities should get their accounts audited and such are not mandated to do so. Like, for example, in India, every person is required to get accounts audited if turnover crosses a certain threshold limit under the income tax law. It is also possible that some entities, like schools, may be required to get their accounts audited for the purpose of obtaining grants or assistance from the government. Auditing is not always mandatory. Many entities may get their accounts audited voluntarily because of the benefit of auditing. As stated earlier, an audit gives an investor confidence. It provides assurance that all that is stated in the books of accounts are true. Now, moving to the next question. Who appoints an auditor? Generally, an auditor is appointed by owners or in some cases by constitutional or government authorities in accordance with the applicable laws and regulations. Like in case of companies, an auditor is appointed by members, that is the shareholders at the AGM, annual general meeting. However, in the case of government companies in India, an auditor is appointed by the Comptroller and Auditor General of India, CAG, an independent constitutional authority. Then what about a firm that engages an auditor to audit its accounts? In such case, an auditor is appointed by the partners of the firm. Same way, in case of sole proprietor, it is the sole proprietor, the owner, who hires the auditor. There may be a situation in which auditor may be appointed by a government authority in accordance with some laws or regulations. For example, an auditor may be appointed under tax law by a government authority. The last question, to whom audit report is submitted by an auditor? The outcome of an audit is a written audit report in which auditor expresses an opinion. The report is submitted to the person making the appointment. In case of companies, there are shareholders. In case of firm, the partners, or if it is the government has appointed for legal or tax purposes. And that concludes today's session. Today we have learned what is the meaning of auditing, what its definition is, what is its characteristics and scope, and we have got answers to certain questions. In our next session, we will cover importance of auditing, the difference between accounting and auditing and investigation, and the objectives of auditing. Thank you for watching, and for more such informational content, please like, share and subscribe to our channel.